Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host at Algobot, and today we're studying an expert advisor called Engulfing Reversal Hedge. This is a pure price action approach, which means it uses no traditional indicators at all. Instead, it reads raw candle shapes and the structure of the market around them. Over the next few minutes, you'll learn how it spots a reversal at a swing point, how it waits for a breakout to confirm that reversal, and how it manages risk with a hedging leg. Remember, this is educational information only and not financial advice. Let's get started. So what exactly does this expert advisor do? At its heart, Engulfing Reversal Hedge is a reversal and scalping strategy built entirely from price action. It does not use moving averages, relative strength, or any oscillator. Every decision comes from the geometry of the candles themselves and the swing structure around them. The strategy is designed for liquid markets, such as major foreign exchange pairs like the euro against the US dollar or the British pound against the US dollar, and also gold against the dollar. It's intended for faster time frames, such as the 5-minute or 15-minute chart, which are quick enough for short scalp-style trades, yet still print clean swing points. There are 4 core ideas working together. First, a pivot, which is a recent fractal swing low or swing high that marks a structural turning point. Second, an engulfing pattern, a classic 2-candle formation that appears right at that pivot and suggests the prior move has been overwhelmed. Third, a breakout. Instead of entering the moment the engulfing candle closes, the strategy places a stop order just beyond the pattern and only enters if price follows through. And fourth, a hedge. If that breakout proves false and price moves back against the position, the strategy opens an opposite leg to manage the adverse move. Distances in this system are not hard-coded in pips. They scale to the size of the engulfing candle itself, so the same settings adapt across different symbols and time frames automatically. Who is this style suited for? It's aimed at traders who are curious about structure-based, indicator-free systems and who want to understand how pending orders and hedging logic can fit together. As always, trading carries real risk, and losses are a normal part of any strategy. Nothing here is a promise of performance. It's simply a study of how the code behaves. Let's walk through the exact logic step by step. On each newly closed bar, the strategy first checks whether it already has a position or a pending order working. If it's flat and idle, it looks for a fresh setup. It begins by examining the 2 most recent closed candles to see if they form an engulfing pair. A bullish engulfing means the newer candle closes higher than it opened, the older candle closed lower than it opened, and the newer candle's body wraps around the older one. A bearish engulfing is the mirror image. Next, the strategy confirms location. It searches back through the look-back window for the most recent confirmed fractal swing. A swing low must have a set number of higher lows on each side, defined by the PivotSpan, which is 3 bars on each side by default. The engulfing pattern only counts if its extreme sits close to that swing, within a tolerance scaled to the recent range. When a bullish engulfing forms at a swing low, the strategy does not buy immediately. Instead, it places a buy stop order just above the engulfing high, offset by a small breakout buffer. The trade only becomes active if price climbs through that level and confirms the reversal. A bearish engulfing at a swing high works the same way in reverse, with a sell stop placed just below the engulfing low. Once a stop order is placed, it has a limited life. If price does not reach it within the chosen number of bars, which is 3 by default, the order is canceled and the strategy resets. This keeps stale setups from lingering. Now to risk control. The stop loss is set beyond the hedge level, a distance built from the hedge fraction plus a stop pad, both scaled to the engulfing range. The take profit is a reward to risk multiple of that distance, which is 1.5 times the risk by default, a quick scalp target. Here is where the hedge comes in. After the order fills, if price travels back against the position by the hedge fraction of the pattern range, the strategy reads that as a false breakout and opens an opposite market leg. On a hedging mode account, both legs now coexist, and the opposite leg rides the adverse move. Finally, the whole basket is governed by money management. If the combined floating result reaches the basket profit target, every leg is closed. If it reaches the basket loss limit, everything is flattened. This caps the outcome on both sides. Let's look at the actual MetaQuotes language code on screen, just as it appears in MetaEditor. At the top are the input parameters. PivotSpan sets how many bars define a swing on each side. Swing lookback controls how far back the strategy scans. Zone fraction sets how close the engulfing must sit to the pivot. Trigger fraction is the breakout buffer beyond the candle. Hedge fraction defines the adverse move that flags a false break, while stop fraction adds a pad beyond it. Reward ratio sets the take profit as a multiple of risk, and entry-expiry bars cancels an unfilled order after a set number of bars. Below the inputs are the two signal blocks. The long block runs when bull engulf is true. The code finds a recent swing low, checks that the engulfing low sits within tolerance of it, then computes a breakout level above the engulfing high. It sets the stop distance from the hedge and stop fractions, places the stop below the entry, and sets the take profit or reward ratio multiple above. It then calls arm breakout with a buy stop order type. The short block is the mirror image. When bear engulf is true, the code finds a recent swing high, confirms the engulfing high sits near it, and computes a breakout level below the engulfing low. The stop sits above the entry, and the take profit or reward ratio multiple below, placed through arm breakout with a sell stop order type. Both sides scale every distance to the engulfing range, so no pip values are hard-coded anywhere. Let's bring it all together on this illustrative chart. There's no separate indicator panel here, because this strategy reads price structure alone. I've drawn two dashed reference lines, a prior swing low at 1.0838 and a prior swing high at 1.0899. Watch the left side first. Price is sliding lower, candle after candle, a steady decline as sellers stay in control. The market presses down toward that prior swing low at 1.0838 and prints a fresh low right around it. That bar becomes our fractal swing low, with higher lows building on each side, as required by the pivot span of 3. Now look at the next candle. It opens near the prior close, dips slightly, then reverses and closes well above, its body wrapping completely around the previous candle. That is a bullish engulfing pattern, and crucially, it forms right at the swing low. Buyers have just overwhelmed the sellers at the structural floor. This is the reversal cue the strategy is waiting for. But notice the strategy does not buy here. Instead, it places a buy stop order just above the high of that engulfing pattern. It wants proof. On the following candle, price pushes up and breaks through that level, and the buy entry marker appears as the order becomes a live long position. The breakout has confirmed the reversal. The stop loss rests below the swing low, beyond the hedge level, and the take profit sits a reward to risk multiple above, which is 1.5 times the risk by default. From there, price moves in the trade's favor. The next candles climb steadily, and at the take profit marker the long trade reaches its target and closes. Notice how the structure made sense. A tested floor, a reversal in momentum, and a confirmed break before committing. Now the market keeps rising into the second half of the chart, and a new setup builds in the opposite direction. Price pushes up strongly toward the prior swing high at 1.0899 and prints a peak right around it. That bar becomes our fractal swing high, with lower highs on each side. Then comes the mirror pattern. The next candle opens near the top, but reverses and closes lower, its body engulfing the prior candle. That is a bearish engulfing at the swing high. Sellers have just overwhelmed the buyers at the ceiling. Again, the strategy stays patient. It places a sell stop order just below the low of that engulfing pattern. On the next candle, price breaks down through that level, and the sell entry marker appears as the short position opens. The stop loss sits above the swing high, and the take profit is placed a reward to risk multiple below. Price then falls through the following candles, and at the lower take profit marker the short trade reaches its target and closes. There's one more layer worth mentioning, even though this clean illustration didn't need it. Suppose that after either entry, the breakout had failed and price snapped back against the position by the hedge fraction of the pattern range. In that case, the strategy would open an opposite market leg, a genuine locked hedge, and let that leg ride the adverse move while the basket money management decides the final outcome. So across both trades, the pattern is identical. Find a swing, wait for an engulfing reversal, ask for a breakout as confirmation, and manage the position with structure-scaled stops and a hedging safety layer. That symmetry is the core idea of this expert advisor. That brings us to the end of our breakdown of the Engulfing Reversal Hedge expert advisor. We covered how it identifies a fractal swing, how it reads a two-candle engulfing reversal at that level, how it waits for a breakout to confirm before entering, and how its hedging and basket money management work together to handle trades that move against it. We also walked through the actual MetaQuotes code and a full chart illustration of both a long and a short sequence. Remember, everything in this video is educational information only and not financial advice. Trading involves real risk, and losses are part of the process. If you found this helpful, please like the video, leave a comment with the strategy you'd like us to study next, and subscribe for more MT5 strategy analyses. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.